Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, markets are growing wary as data and policy signals are getting a bit volatile. First, we have an American non-farms payrolls report due out tomorrow, and today ADP released its version, and that was something of an unexpected surprise. Markets were expecting it to show a 200,000 jobs gain and just below the 217,000 gain it reported in July, but it came in at just 163,000. Analysts are expecting tomorrow's non-farm payrolls report to show 195,000 gain, and they will be on tenterhooks now. There were two reports out overnight claiming to measure the state of the giant US services sector. The first traditional one brought in a blockbuster result, with the services PMI up to almost an unbelievable 58.5 index level, a jump of 2.8 points. That's on strong new order gains. But measuring the same sector in a similar way, the market services PMI was much less enthusiastic, recording a weaker new orders outturn and overall expansion easing. Take your pick. The market survey uses the same basis as most other international surveys, and they report service sector business activity slowing globally. The China report also recorded a slowing of its expansion in August. In Canada, analysts were expecting a rebound in July from an unexpected decline in building permits, but they didn't get it. They were down again in July. While the Vancouver housing market is in the doldrums, the Toronto market is showing signs of vigour. Sales, listings and prices are all up with healthy gains. In Germany, factory orders fell for 6 months, surprising many because a rise in July was anticipated. A slump in export demand from growing trade tensions is clearly biting Europe's largest economy. And we don't report on Switzerland very often, but today we need to report that the Swiss GDP growth for the June quarter came in very strong, up 3.4%, a big improvement on March 2.9% rise. Interest rates may be rising there soon. On Wall Street, a tech sell-off is building. The Nasdaq is down 1% so far today, and that accumulates a 2.5% drop for the week. And there is growing sell-off in Asia, with most markets down a chunky amount. These sentiment shifts are shifting a risk-off mood in markets today. And speaking of risk-off, yesterday we reported that China's policymakers relieved banks of restrictions on lending to local authorities in an effort to boost flagging economic activity. But today we can report most banks are very wary of this new instruction, fearful they'll be left holding increasing non-performing loans, and are unlikely to raise such lending. That's quiet resistance with Chinese characteristics. We should also note that swine fever is now reported in 6 Chinese provinces, all in the populous east. The spread is a serious concern in China, even if it's not widespread yet. Even the UN's Food and Agriculture Organization is showing alarm. US Treasury 10-year yield is down to 2.88% today, and their 210 curve is tighter at just under 24 basis points. The Aussie government 10-year is at 2.56%, that's up 1 basis point. The Chinese government 10-year is at 3.63%, that's down 1 basis point, while the New Zealand government 10-year is at 2.56%, down 2 basis points. Gold is up another $3 and now at $1,199 an ounce, but the World Gold Council is reporting that gold ETFs lost investors for the 3rd consecutive month. US oil prices are down another $1 today and at just under $68 a barrel, while the Brent benchmark is at $76.50 a barrel. And the Kiwi dollar is unchanged at 65.9 US cents. On the cross rates were also little changed at 91.6 Aussie cents and 56.7 Euro cents. That puts the TWI at 69.7. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.